All right, we're recording. Welcome back to the Daily Dilemma. I'm Emma
And I'm Brian
Burns.
Burns.
And
And today
today
we
we
have a,
have,
a
yeah, we have a
guest.
special guest.
I'm going to introduce him for us. His name is Paul Brumund. He's a strategic mortgage lending advisor. He's been doing it for over 20 years. Can you believe that? Uh,
Yep,
he's also got a family heritage in real estate of over 80 years. That's a long time.
it's a long time.
Um, Paul has been a consistent top producer, helping individuals achieve their dream of home ownership, helping out first-time buyers, seasoned investors, military veterans, individuals that are over 62, searching for the perfect reverse mortgage. He's done it all, does it all. In fact, Paul has a lot of resources that he helps his clients with, and a large network of real estate agents, tax accountants, financial planners, property managers, banks, and escrow officers. Paul is somebody that I personally implicitly trust and have done several loans with him. And today we're going to talk about the things you need to consider when you're buying your first home.
Yeah.
Thanks for joining us today, Paul.
Thanks for having me. I'm excited to share all my wisdom and my heritage wisdom.
There you go. I like it. Did I do okay introducing you? Did I get everything?
You got it all. You read it. You read it pretty well. Thank
All
you.
right, cool.
That's my bio. Yeah.
so, so today we just wanted to ask you I personally purchased a couple homes in my lifetime. I'm a little older than Emma is, but Emma's never bought a home. And she's at an age where she's starting to think about what she needs to do to prepare to buy that first home. And so we were thinking there's probably other people out there that haven't bought a home yet, or
Don't
maybe
even
it's been
know
a
the
long time.
process. I'm lucky enough to know you where I was able to reach out and ask some questions. You walked me through the process, and it was very helpful just because people my age don't really know what that process looks like or what the answers to their questions are or even what questions to ask. So even just like discussing loans, and you had recently mentioned to me how building up your credit is more important these days. And so just talking a little bit about that and maybe why it's important, more important than anything else is.
Yeah. Yeah. So I would say, you know, things are always changing in our industry, and as they do other industries. But right now, so there's all kinds of different loans out there. You've got first-time homebuyer programs. You have VA for VA, FHA buyers, conventional buyers. And so I guess I always tell people to start the process. So to start this process, you should talk to a loan officer. And basically the initial conversation, the loan officer will gather some basic information from you. They'll ask you for your name, your employment history, how you think your credit might be, and income information. And off of that information that the loan officer gets, they're usually able to make a preliminary observation about whether they can help you out. And then what if you need to do something to either clean up your credit or get more income or maybe save more money for a down payment, that's where you need to start. You really need to start right there. And so the great thing about right now, so this is what we're January 31st of 2023. The market's changing. It's changed a lot for first-time home buyers. So opposed to what's been going on over the last several years, where you got people that are coming in and maybe you have some investors that want to buy property. You've got people that are going from one house to another. They're in their primary home now. They want to sell that and buy another one. The market has purposely slowed that process and is geared more towards first-time home buyers. So there's a lot of programs out there where there's assistance for your down payment. The interest rates are actually much lower right now than they would be for someone that's already a seasoned homeowner or an
wow.
investor. Yep. And so right now it's a really good time to purchase, even though the prices, over the last few years have gone up. They are coming back down a little bit. Um, interest rates as a whole are going up. However, first-time homebuyer rates are pretty low right now.
Oh,
So
that's interesting. So what's the difference between like regular interest rates and first time home buyer interest rates? And how would that affect the overall loan?
right now, I did some pricing this morning for someone who was going to put 20% down on a conventional loan. They're a homeowner currently, and they want to purchase, they want to sell their house and buy another home, a replacement home for them. They have pretty good credit. And their 30-year fixed conventional rate was at about 6.5%. So you mirror that with the first-time home buyer interest rate that really doesn't have to put that much money down, and
Right.
they were in the mid to high fives.
Okay.
So there's additions, what we call additions, and things that are added right now to the matrix for whether you're a first-time home buyer, whether you're an investor, whether you're you're someone that's purchased a home, you're going to buy another one right now. There's all these additions to all these rates and things. And so right now there's more subtractions for first-time home buyers than there are additions on the rates.
Nice. So you can get a little bit less for if you're a first-time buyer. That's nice.
You can.
So then I have a question on top of that.
Go ahead.
So say you are like a first time home buyer, and like as I'm looking at homes versus townhomes versus condos, etc. Condos, the downside of it is that you pay like a higher HOA usually. However, it's a little bit cheaper than a regular house. And even townhomes are sometimes a little bit cheaper than a regular house. However, if you're looking in the long term, would you say that it would be better to buy a home because since you are a first time home buyer, the interest rate is going to be lower, so you could keep it for longer because it is going to be bigger and you could grow in it? Or would you say that, start in the condo where it's a little bit cheaper to gain the equity right off the bat, and then move into the home and pay a little bit more in interest, but at least you would already have that equity under your belt with the condo?
That's a good question. So I always tell people it's a make sense thing. So what you do is you need to look here in California. Tax rates vary from neighborhood to neighborhood, and so I could be in a 1.25% property tax area, and I go right down the street and we're at a 3% tax rate area. And the same thing applies to condos. You've got HOAs that are higher or lower, plus you've got their tax rates. So in a situation like that, even though the prices of condos are generally quite a bit less than a stick-built home, you really need to just talk to an agent as well. So talk to a real estate agent, talk to your lender. And then what I always tell people is send me a few addresses that you have. So you've been looking at condos on 6th Street. And by the way, Paul, here's a few of the condos we're looking at, and the price is $350,000. And here's a few stick-built homes that we're looking at, and I have you send those to me, right? So look at those. I pull the tax rates, I pull up the HOAs, and it's a simple math. It's a simple math thing as far as what your monthly payment's going to be. Now, long term, when you're talking about whether a condo is going to be whether
a better investment
value or go down in value over the years, I think historically stick-built homes in general areas, stick-built homes tend to go up more in value. Not always, but they tend to, especially here in Southwest Riverside County, it tends to do that. So again, it's a make sense thing. We plug the numbers in, you take a look at it, and you decide which one that you want to do. If that makes sense.
Yeah, it does. I think you've given me that advice in the past, and I really like it. It's basically buy what you can afford. Don't worry about what anyone else tells you, or whether you can get qualified for it. It doesn't matter as much as if you can actually afford it, right?
Right.
And so I think that's really good advice. I was going to ask another follow-up. You mentioned conventional loan, first-time buyer loan, those kind of things. what are the different types of loans? What should people consider when they're looking at different loans? You know, there's also the term, right? Like, do I get a 20-year, you
Yeah.
know, like 20-year fixed, variable, all these different things.
Yeah. So there's the run of the mill. We have FHA, VA, and conventional / conforming loans. FHA and VA those loans were designed and they were brought into existence for lower income buyers. So knowing that, the rates generally are lower than they would be for a conventional loan. But if you put less than 20% down, you're going to pay some sort of mortgage insurance usually. VA, if you're a veteran, and you're going to use a VA loan, unless you're a disabled vet, you're going to have something called an upfront or a VA funding fee. And if you have if you use an FHA loan, you're going to pay something called an upfront mortgage insurance premium. Plus, on the FHA loan, you're going to pay monthly mortgage insurance. Regardless of whether you put on an FHA, regardless of whether you put 20% down or not, you're always going to have to pay those fees. And so the way that it usually works is you got a first-time home buyer FHA because they require less money down, 3.5% down generally. Or if you get on a first-time home buyer program, you can get in sometimes with 0 down.
Okay.
But 3.5% down FHA, you're going to pay upfront mortgage insurance fee. You're going to pay the monthly mortgage insurance fee, and you're going to pay that monthly mortgage insurance fee forever, as long as you own that loan, as long as you have that loan. Now, what we usually as loan officers tell people that are first-time home buyers is, you know, if it makes sense and you have a minimal amount of money to come in with, do the FHA, stay in the house for a while, gain some equity, and then if it makes sense and the rates get better, then refinance out of that and go into a conventional loan. So you drop that monthly mortgage insurance fee.
Is that usually what they call PMI? Is that it?
It is. Yeah.
Same thing. Okay.
Yeah, PMI. Yep. So that's kind of how those loans work. There are some other loans in the industry that are outside the realm of first-time home buyer loans that we don't want to get into today. But as a general census, when you're talking about first-time home buyers, FHA and conventional sometimes is the best. Okay. But generally FHA is.
Gotcha.
Yeah.
So you mentioned 3%, you mentioned 20%. So typically first-time buyer would need to set aside or save up 3.5% in order to put that down on their house. So if you're buying you know, a $400,000 house, for example, first-time buyer, it's crazy that houses cost so much these days. Times 3.5%, you'd have to save 14 grand. Is that about right?
Yeah. So that's the minimum required down payment. Okay. Not necessarily does that need to come from the buyer. That money can be a gift. Okay. So you can get that gift. That gift can come from a relative, come from an employer, and there's other ways too. We've got some other first-time homebuyer programs where they will actually they'll provide a gift up front for you. Those loans are generally a little bit more expensive to do, but yeah. So the minimum required down payment for those FHA loans is 3.5%, regardless of where you get it. As long as you come in with that money's brought into the contractor, into the loan to drop the loan amount, then you're good to go.
And if you're doing conventional loan, it's probably going to be what, 20%? So on
conventional loans, you can do conventional loans with less than 20% down, but then you're getting into, you also have to pay. There's a PMI that's involved with that as well.
If you don't do the 20%.
If you don't do the 20% down.
So ideally, you'd want to have the 20%. And so on a $400,000 house, you're talking about $80,000.
Yes.
Something like that. Okay.
Yeah. Mm-hmm. Now, one of the things I'll tell you that's important. So you can do a 5% down conventional loan, right? So you bring in a little bit more money. If you have really good credit, even though you're going to pay PMI every month, that PMI is going to be pretty low. If
Okay.
your credit score is not that great and you bring 5% down as a down payment, your PMI, your monthly mortgage insurance, that's going to be pretty high. So
Okay.
as Emma alluded to earlier, it is important nowadays, especially always, but really nowadays, is to try to keep your credit as good as you can, because that really
Now,
makes
what do you see? Sorry to cut you off.
no, you're good. I can ramble all
What
day.
what do you see as like a great credit versus a good versus a bad credit
So
score?
we can do FHA purchase loans. I can anyway, as low as a 580 credit score.
Mm-hmm.
Some lenders will go less than that, and they do what's called a manual underwrite, so it's not approved on an automated system. So a human being underwriter will go in and manually underwrite that. So that's the lowest that I've seen. I would say a good credit score is something over 680.
Okay.
You're going to get better pricing at 680, and then if you get into the 720 range or above, you're going to be looking much better.
Cool.
Okay. So ideally, you want to be over 720 if you can get there.
Yeah. I want to bring one more thing up about that. Credit Karma, Experian.
Well, that was what I was going to ask you. How
I get
accurate are those little
perfect.
apps?
There you go. Every day I get a call. Oh, my Credit Karma score is 780. There's been one time out of hundreds of credit reports that I pulled, one time when the Credit Karma score was actually higher than the score that I pulled through our algorithms. So there's different. I'm not a credit expert.
You mean lower?
There's been one time when the credit score has been higher.
The one that you pull.
Well, let me back up. So the what did I say? So the credit. So somebody called me up. I have a 750 credit score. Credit Karma. Yeah. Okay, great. I pulled it up on mine, and it was a 7. There's actually my credit score was higher. It was like a 782 or something.
Okay. Yeah.
So, but you got to be careful about that, especially, a lot of people look at those. A lot of people, they're super, and it's good to be conscious of good credit, and it's good to check to see when your score goes up. I think that's great. That's all good stuff. But you need to talk to your mortgage professional so that they can pull an actual credit score that's going to adhere to their guidelines.
Right.
Because that's
that brings me to another question that you always hear, and I want to know what
I know exactly what you're about to ask too.
Do you want to ask it, Emma?
I think you're about to ask like hard inquiries, how it actually affects your credit in the long term.
Exactly.
Yeah. So something just happened recently in our industry. I have not always pulled soft credit scores. Matter of fact, I've never done it up until recently. And the reason is because the credit reports are getting really expensive. And so my boss said, hey, we gotta start buckling down. So to answer your question about soft pulls, your soft pull is not supposed to affect your credit score. A hard pull apparently will from time to time if you have too many inquiries over a period of time. I'm not a credit expert, but I know kind of how these things work. So, but I always tell people, if they're serious about getting a home loan, they need to talk to somebody and have them pull their credit report. Have them pull it. And now you're done, right? So those credit reports are good for 90 days. And so you'll know what you're dealing with within that period of time.
So if you have one lender pull it, but you decide you want to go with someone else, did they have to pull it too?
They do. Yeah.
Okay.
They'll have to pull it too. Yep.
Okay.
Yep. And then their score conceivably could go down a little bit, but it's probably not going to go that much. If nothing else has changed, you haven't gone out and racked up a bunch of your credit cards and got new loans, it's not going to affect it that much.
Okay.
I will say it was interesting when mine was pulled, like you said, like when I was checking my credit, it was higher than when you pulled it and then you told me my credit. However, it was almost beneficial because now my Credit Karma shows the number you gave me rather than their suggested number or like what it was at. And now it's accurate. Like now it's consistent with the exact number you gave me. And I still have, I still do everything correctly. Like I've never missed a payment. I have had all my credit cards for the exact amount of time, even more now. But yeah,
Well,
that's what I found interesting about it.
that is interesting, and I did not know that. So that's good. That's really good. Yeah.
So how do you recommend, and maybe this is something that you can answer, maybe not, but if I'm a first time buyer, it means I might even still be living at home with my parents. So I haven't really made a budget for myself.
Yep.
I might not know how much to plan on, how much income I need to have in order to afford a certain size mortgage because I still have utility bills and car payments and other things that are going to cost money. Maybe, if I buy a house, I've got to maintenance my lawn. And if I have a pool, there's
Mhm.
costs associated with that and all these things.
So
Um,
maybe what percent of your budget should you set aside for your housing income?
That's up to the individual. There's nothing set in stone about that. It's, some people are very frugal and they don't want all their money going toward to their mortgage payment, and some people want to max out. And so it just kind of depends on what your budget is and what you're used to budgeting. But those are good things. Those are things that you need to be aware of. Um, as I mentioned previously, we're talking about the condos. You got HOA when you buy a home. You need to see if there's an HOA
Yeah.
associated with that house. You need to see what the tax rate is. And I believe there are programs out there. I think realtors have access to these programs where you can see on average what the utilities were on a specific home. So
Yeah.
that's cool.
you can access that information too, so that about what that's going to cost you every month.
Okay. That's good to know. I've heard the number and maybe, maybe this is just a shot in the dark, but I've heard the number that you should be earning 3 times whatever your mortgage is,
Yeah,
somewhere in that realm.
that's a good number for qualifying purposes, which is going to freak you out if you don't know this already. Uh, we go off of your gross income, so we don't even go off of your net.
Okay.
And what you'd think that if I were a bank and I was lending you the money, that I would want to go off the money to get net, but we don't. We go off the gross numbers.
Okay.
And then there's something called a debt to income ratio. So debt to income ratio is basically your income, how much income do you have and how much debt do you have on a monthly basis going out every month. And that debt to income ratio in general is just under half. So, if your debt to income ratio is 49%, we can actually get you a loan. So that's saying half of your money that you gross every month can go towards and this is not including all of your utilities. This is just
Utilities and all
including
this. Okay.
the debt that would show up on a credit report and your new mortgage payment. So, at the end of the day, I always tell people, and I firmly believe this, and if, you're silly if you don't look at things this way anyway, but you got to be able to afford it. You know what your budget is, you know what your spending habits are. You should monitor yourself. I had a guy that called me up on the phone yesterday, and been working with him for a while now. He finally sold his house. He wants to buy another one. He's an older gentleman, and he goes, "Well, what do we qualify for?" And I said, "Well, I can tell you, you qualify for about 500,000. But what you should really be asking me is what's your monthly mortgage payment going to be? Because
Mhm.
you're the one that needs to be comfortable spending that money."
Right.
Yeah.
So in his case, he was able to qualify for more, but I knew he didn't want to go over a certain amount of money every month for his mortgage payment. And so but people get weird about that. They're like, "Oh, I want to know how much I qualify for." It makes them feel bad.
Yeah. Right. Right.
And
Well, yeah, I mean,
that happens
sometimes
with
you just
younger.
want to know.
You do, I guess. I mean, just so you can
Yeah.
brag about it, I guess. I mean, I don't know, but that does happen a lot with younger homeowners. They're not used to the realm. They're not used to um, they're just not used to the reality of what life brings to them
Yeah.
from a financial perspective. So,
Right. And that's kind of
Yeah,
why we wanted to do this. Go
yeah,
ahead,
I
Emma.
think it was interesting for me because I honestly didn't know like what qualifying meant, like the meaning behind qualifying for a house. And so going like through the process with you, it was interesting to find out, okay, qualify, but there's no way that with just like with my income, even though I qualify, I can make that payment and still pay everything else. And so as someone who is interested or is going to be in the future a first time home buyer, I I thought that the bank would tell you, okay, based on your income, not only do you qualify, but you'd also be able to pay these expenses that come along with it, because, not only is it utilities, but it's also just property, like property expenses or property costs.
Yeah.
All these other variables, even food, like how are you going to supply food if
Right.
if your whole income is going towards your housing, or if you have an off month, you take a day off because you're sick, and then it's like it's just really, it's crazy because you do qualify, but you definitely have to factor in everything else.
Yeah. And those are things that you're way out of high school. But I mean, back when we were your dad and I were in high school, and you and those are things that should be taught to us. Those are things
Yeah.
that we should learn before we graduate from high school, and
It's
those
not
things
part
aren't
of
taught.
it's
Huh?
not
What's
part of the
interesting
curriculum.
is
No.
I graduated from college, and you'd think that as like business,
A business
I don't
major.
know, business major, you would find out some of this, but we weren't taught this. We're
Crazy.
taught how to, it is crazy. And so it was really interesting just listening to you talk about, I mean, all the loans, and even now hearing some of the stuff, because yeah, we aren't taught it, and it's important. You have to have a house. Like when everyone needs a place to live. And so yeah, it's crazy we aren't taught it.
Yeah,
Yeah.
there are some counseling places that you can go to. When I do reverse mortgages, which are mortgages for people that are 62 or older, there's this thing called a reverse mortgage, and it's a different loan. There's a lot of a lot of those loans there's parts of loans that are the same, but many differences, and so they have to go through a counseling course. And when you get into a first time home buyer program, a lot of times those loans will require that you go through a counseling course as well. So they won't let you do a loan until you go through those things. So
Interesting.
yeah, so those are very, very helpful for people.
Mm-hmm.
But for the general public, it's not a requirement, so people just don't do it. But
Right.
I think it should be. I mean, I think that in our industry also, the definition of a first-time home buyer is someone that hasn't owned a home for 3 years. So you could have owned a home, 10 years ago, and you rented for a few years, and now you're back in the market and you're considered a first-time home buyer. Well, those people, they know how the process works because they've been through it before. But for someone like you, Emma, that hasn't been through it before, it would be helpful to go through something like that so that you can budget it and get a sense of all that.
Yeah, and
That
I
is
think
interesting. That so if you rent for 3 years, even if you've owned a home before, you're considered a first-time home buyer. So then, does that mean that you apply for all of the same loans that someone who's never bought a home before does?
You can. So that's that at this point today, a first-time home buyer is an advantage. So yes, that would be an advantage for someone to purchase a home that maybe was a homeowner up until 3 years and one day ago, and then they decided to rent. Now they're back on the market again. So, and I got to tell you, it used to be up until recently, even though people would say, "Oh, I'm a first-time home buyer, I want that program," it didn't really
I
necessarily mean
remember that.
that wasn't a great thing. Yeah, not
Yeah, these
necessarily a
things
great thing
change, don't they, over the years?
all the time. Yeah, they do.
So what I'll say is, for somebody like Emma, I remember doing this when I first started renting. In fact, Paul and I go way back. We actually rented an apartment together one time, many, many years ago.
And you
And
fought about milk, right? Wasn't that
yeah,
the
No,
yeah,
we don't
but
want to get into that
we don't.
conversation.
Yeah, we don't. Paul's gonna get real upset. No, but
Right?
I
Yeah, go
remember
ahead.
my parents had me, gave me this idea. But you can, now that we have the internet, you can go online and just Google a simple personal budget,
Yeah,
and and it'll help you to think about, write down, what are you paying for your car? payment every month? How much is your mortgage going to be? What are your utility costs going to be? And as Paul mentioned, you can even Google that neighborhood and figure out what the average utility prices are in those areas. What's your credit card payments? What do you think groceries are going to cost? And if you're renting, you'll probably know most of this, right? Or at least have a pretty good feel for how much you're spending on groceries and that kind of thing. If you're not, then you need to talk to friends and see what it costs them and get an idea, because those things add up. And if you don't have the budget for it, then you might want to wait a little longer, or take
Yeah.
I
get
will
a second
say
job. I don't know.
it was interesting, like moving into my first apartment, because they tell you the upfront costs, which is say like 1,800, and then you go to sign all the papers, and you're like reading through everything, and you're like, okay, so we're gonna charge you $100 more for your trash just to put it outside. Even if you just want to take care of yourself, we're still gonna charge you the $100. And then like all your utilities, you're gonna go through this company, and that's gonna be another $60. And you just start going down this list of things, and that number just slowly drifts away. And it's like, okay,
Yeah.
so you're at $2,200 for your total rent. And then you still have your groceries and stuff. So it definitely is like an eye-opening experience, but I think one that needs to be discussed, so that when you are budgeting, you're making sure you add a few hundred to what you think it's going to cost.
Yeah. Yeah. And it's smart that you're going through the process and trying to figure this stuff out. You should never be in a hurry to purchase. Sometimes there's a frenzy to purchase if people hear the market's going down, rates are getting better. It's not a good idea to just jump into something not having the knowledge that you need to have when you make a big purchase like this. So it's smart that you're doing that. And again, things change. We were in a seller's market up until about 9 months ago, and all of a sudden things started to change. And now it's more of a buyer's market, but you have to be able to afford your payment. You got to be able to make your bills. You don't want to lose your house for sure. You don't want to be in that situation where you're living to make your mortgage payment. And so it's smart that you're going through that. And all first time, everybody, but especially first time home buyers, should educate themselves and have a good understanding as much as you can as to what's going to happen once you move into that house.
Yeah.
And Paul, you've been doing this a long time, and obviously your heritage. Would you agree that over the long term, I'm not saying it doesn't fluctuate, but over the long term, real estate in the United States typically goes up in value?
Yep.
Over time. So if you buy it
Absolutely.
now, even if it dips down in value over the next couple of years, it's eventually going to come back up, and it'll be worth more than you paid for it at some point.
Yeah. I talked to a prospective client yesterday on the phone, and they're in their early 70s. Okay. And I'm asking them my normal questions: what's your address? How long have you lived there? What's your rent payment? They've been in an apartment for 30 years.
Wow.
30 years. And the husband told me that he said, we were in the process of buying a house about 25 years ago, but the agent steered us wrong. We came in at a full price offer. The agent at that time said you should never come in at a full price offer, and they ended up losing the deal, and they got frustrated. And that was it. I mean, that was it for them. They thought, well, and I'm thinking to myself, oh my gosh, 30 years ago, that house you would about 25 years ago, you probably would have paid, I don't know, 120,000. That be worth a
And
lot
it would
more.
have been paid off by now, almost, right?
Almost
30
paid
years
off.
ago, yeah, 30-year loan.
Yeah. So to answer your question, absolutely. You talk to anybody, real estate is a staple in all kinds of stuff, financial wealth, retirement, all kinds of. There's a lot of great reasons to purchase a home, but you need to be able to afford it first and foremost.
Well, and there are some properties, I don't know if you could talk more about why and like the difference, but manufactured homes don't nearly increase in value as much as others, as well as one bedroom, one bathroom homes or condos. And then also, I wanted to ask you about, there's a like zip kit homes now, where if you're like going to build a home, they pretty much supply like the walls and it's in the ground, but I don't know how that varies, and if you know how that varies and how well it does over time, whether it increases in value as much as a stick-built home will.
I've never heard of that kind of home. What's it
Oh, you've
called?
never? It's called a zip kit home, and they're basically they just fly in like all the sides, like everything is.
The walls are pre-built. It's like they ship in
But
these
they build
walls.
it in the ground. It's just that everything
So it's like,
is
okay. So so it's
Could be
prefab home.
manufactured.
There's
Yep.
probably different words for it. Yeah, prefab homes.
prefab home, yeah.
Yeah, so prefab homes, prefab homes, they're attached to the ground. They become real property. And I don't think, unless it's in a tract or a community of all prefab homes, I think once that thing is built on the ground, I don't think there's a giant difference as far as resale value goes.
Okay.
Manufactured homes, historically, you're correct. They don't hold their value as much as a stick-built home. Mobile homes that are in a park that you have to pay lease space on, that you don't own the property, that's a whole different animal that I don't really know much about at all. But yeah, I mean, stick-built homes it's historically always been the one that's gone up in value. That's the one that you can get the better pricing on, the better interest rates on. Interest rates are usually higher for manufactured homes. Usually are.
Interesting.
Yeah, homeowners insurance is usually a little bit higher on those as well. The deductible is a lot lower, which means your homeowners insurance is going to be higher on those. And there's a gamut of reasons why, but yeah, stick built usually holds their value a little more.
And probably a realtor would be able to help you, guide you with some of that stuff too, right?
Right. Yeah. Yeah, they can.
Okay.
Yeah.
Cool. Well, Emma, did you have any other questions for Paul while we have him on?
I don't. I think most of my questions were answered.
Yeah, this is really great. Thanks for joining us today.
Hey, I want to share one more thing with you, just because this is what's going on right now. And I probably should have mentioned this earlier, and I think Emma knows this, and I think you probably do too, Brian. Because it's more of a buyer's market, I'm encouraging, and I'm educating realtors on doing this as well. And that is because it's more of a buyer's market, ask for the seller to pay your closing costs. Ask for the seller right now to pay a discount point to get your interest rate down. I was working with a client today, and they wanted to get their rate as low as possible. And the par rate for them, the going rate for them with their credit score and their down payment was at 6.25. However, we could get that down to 4.875 if the seller paid, I think it was $10,000 in this case. I think the purchase price was $330. So that's a big deal right now.
Yeah, wow,
it's
that's
not
awesome.
uncommon, and people should be doing that. That may change next week, next month, next year for sure. But right now, being that it's more of a buyer's market, sellers need to make it more desirable for people to purchase their home, and so they're willing to do those kinds of things. So
interesting.
One of the things I'll mention too, while we have Paul here, just a little plug for him. If anyone listening is interested in a lender, Paul's a great one. And what I found with him over the years is that he gives advice that he would take himself. Like he advises all of his clients the way that he would his own daughter or son or a friend or family member. So I feel, when I said that I trust him implicitly, I think that you can too. He's an honest guy and does the right thing. And sometimes that, isn't always the best thing, for the sale or for himself, because it might be advising someone not to buy a house or not to take a certain type of loan because it's not good for them. But he'll, explain those things. And I think that's what you need in a lender, whether it's Paul or somebody else. You want somebody that you trust that is going to advise you for what's best for you and not necessarily just to get things done.
Thank you, Brian. I appreciate that. And I've told you this before, and I'm not a mega producer. I've had an opportunity to be a mega producer throughout my career, and I've always chosen not to do that because I don't feel with me, the way my work, the way that I work, I can't do an overabundance of business and still be focused on the people that I'm working for. I can't do that. Some people may be able to do that. I can't. So I like to sleep at night. I like to be able to feel good about what I've done during the course of the day. And so I do work that way. I tell people the same. I tell everybody the same. I give everyone the same advice because I think that's right. So.
Yeah, and I think that plays well in the long run because
You're
people feel
trustworthy.
people feel comfortable recommending you as well because
Yeah.
and I've talked about that with sales as well. Emma and I've had these conversations. It's like you want to do right by your customer, whether or not you end up getting the deal. You want them to feel good about the interaction they had with you because that's going to lead to, credibility and things that could, come to fruition down the road, and usually does if you do the right thing.
Yes, sir. Yep, I agree with that.
We really appreciate you. Thank you for coming on, and we'll let you know if we get any questions in the comments, and
cool.
see if we can answer them.
Yeah.
All right. I appreciate you having me on. Emma, I wish you the best. You can call me whenever you want. And
Yes,
thank you guys for the opportunity. I appreciate it.
You got it.
All right. We'll
All
talk to you
right.
later.
Bye.
Bye-bye.
Bye.